Hi, this is Stephen here from Share Navigator, and this is going to be a 10 to a 12 minute tutorial on how to manage a short strangle trade that's under pressure now. The $87 short call position is starting to come under pressure. So we get stuck into it straight away. So we're going to review the original trade, actions we've taken since we've placed the original trade, our current position, a reminder of our break-even point, and give you a couple of options that you can do to repair this particular situation. So the first one is the original trade. What did we do? Well, it was an earnings play on Yum. We placed the $87, $70 May 15 short strangle. In other words, we wanted the shares to finish somewhere between $70 and $87 by the 15th of May. So the first trade was we sold the $70 puts, we received 20 cents. And trade number 2 was we sold the $87 calls and received 58 cents in premium. So we got paid $78 per contract upfront for basically if shares finished between 70 and 87. That's the bottom line of the trade. So earnings came out. There was a strong move upwards, but nothing too concerning for our positions because the shares went up $2 and our calls were still $2 out of the money. So we were happy with that particular situation. Our put options were almost in full profit, so we like in Share Navigator to take the profits off the table, and we paid 5 cents to close down the put side of the trade, and that gave us a profit of 15 cents per share on the put side. And then we left the calls open because they were still out of the money. So where are we now? It's based on the 24th of April at the close, the shares of Yum have risen to 87.10. So now our short call position at 87 is under a bit of pressure. It's now in the money by 10 cents and we have a risk of being assigned by the 15th of May. So we need to start planning as to what we're going to do. So before we do that, we need to have a reminder of our break-even point. The put side of the trade was profitable by a factor of 15 cents. Our income from the call side of the trade was 58 cents. So our break even is the strike price plus the total premium received. So our strike price is 87. That's where our short call position is. We know we have an already booked profit of 15 cents from the put side, and we've income that we took in from the call side of 58. And that gives us a break even point of 87.73. So as long as Yum finishes below 87.73 between now and expiry Friday and the 15th of May, we will still make a profit. We will make full profit if it stays below 87, but we will still make a partial profit between 87 and 87.73. So that begs the question, what are we going to do? Well, the answer is that really depends on your outlook. If you still believe that Yum's shares are going to finish below $87 by the 15th of May, and that's a possibility because the shares have risen nearly 10% or just over 10% in a very short period of time, and usually that is followed by some profit taking. So you know what, you may not be the type of person that presses the panic buttons, and you might want to still see this play out. So the only other thing you would need to consider is there a dividend, ex-dividend date between now and expiry on Yum? And there isn't. So you don't have to worry about an ex-dividend date. So what you could do is just simply wait for this to play out a bit more between now and expiry Friday. If it's a situation the shares continue to rise, what you would do in that situation is buy back your May 15th calls and then roll them out to June. So you would literally, the premium you're going to pay to buy back your May 15th calls will be offset, and you'll get an additional credit for rolling it forward a month or so. And in essence, you're going to make an extra little bit there, but you still need the shares to start falling below 87. You could roll upwards as well to the 88 strike for June, but you wouldn't do that until we get closer to the time, until we got closer to the expiry Friday. Option number 2 is if you actually think the shares are going to remain above $87, well then just buy the stock and turn it into a covered call. You will still receive the full profit. But if you think the shares are range bound, or you think that they're going to go above a certain level, well then you might want to introduce another out of the money put and turn it into a short strangle again. What this does is it actually increases your break even point up again. Or the second option of that particular one is to buy the stock and sell the out of the money put. So we're going to look at both of those scenarios right now. We've done some profit and loss tables on those particular trades. So here's our original trade on Yum. This was the short strangle. We've already talked about this. We can see that we've bought the shares, the put side, back at 5 cents, so that costs us. And so, you know, once the shares finish above a certain level, we're going to make $73 profit. At the time there was an 80% chance of success. That's all changed now. So once the shares finish below $87, now we're going to make full profit in that particular trade. But unfortunately, you know what, you may not believe that. So we may look at the second option we talked about, which was buying the stock. So buying the stock, we just add a third trade. We're literally going to buy Yum stock at $87. So basically we're turning this into a covered call. That's all we're doing here. So when we add all of that into our profit and loss tables, we can see that our max profit hasn't changed. It's still $73, but now we've turned our probability of success. It's gone up to 68%. Our break-even point is 86.27. So all we need is the shares to finish above 86.27. So if you believe the shares of Yum are going to finish between now and the 15th of May above 86.27, the simplest way to manage this position is just go and buy the shares at 87, and you've turned it into a covered call. Alright, so the reason for placing this particular or adding this leg to the trade is you think the shares are going to stay above 87 and your break even is above 86.27. Another way of managing the trade, if you felt it's going to be range bound, you might feel, for argument's sake, that, you know what, the shares might go up another little bit, but it's going to be range bound to be a bit of a sell-off. Well, what you could do here is sell, basically turn it into a short strangle again. And this time we'd be selling the $85 strike for May 15th. And the premium on offer at the moment is $1. So when we add all of this into our profit and loss tables, our max profit is actually increased by $100 per contract. So that's the good news on this. We've actually increased our profit potential here. However, our probability of success is about 58%. So this isn't a high probability situation. And the reason is we've two potential break-even points now. Once it finishes between 83.27 and 88.73, you will make money. But you'll make full profit if it finishes between 85 and 87. So the reason you're placing this particular trade, if you did do it, is that you feel that the shares of Yum are going to be range bound. You might feel that there'll be a bit of profit taking going on. They might drop a bit, but the bias is still bullish. It's still to the upside, but it's not overly bullish. You think, look, there's a limit to this, and the limit is 88.73. So that would be adding in a short put, turning it into a strangle, a short strangle again. The fourth way we talked about was actually adding in the short put and buying the stock at the same time. So there's actually two extra trades we'd be putting on if we did it this way. Again, our max profit per contract has gone up by $100 to 173, but our probability of success with this particular trade is 73%. So it's a little bit of a covered call, but with an extra bit of premium taken in because we've sold a short put. So our break even is reduced than the previous cover call by almost $1. So it's 85.27. So if you feel the shares of Yum are going to stay, the bias is bullish, it's going to stay above $85, well then this is the trade to do. Again, your max profit is increased. You've basically increased your probabilities of success. Again, the thing to note here is you believe the shares are going to stay above $85. Now, there's another way you're going to manage this trade. If you did place this, and let's say for argument's sake the shares of Yum started to fall, well then what you could do is actually sell your shares. So let's say the shares fell to 86. What you could do in that situation is say, okay, well the premium I received from my put has paid for the loss in the shares. So I'm now going to sell the shares because now the pressure is not on the call side anymore. And you would just leave that put upside open there just to cover yourself, just in case the shares, you know, did go back up. You still have that premium in the bag, and then you can buy the shares again. So that's how you would actually manage it on an ongoing basis. So comparing all four strategies, the first one is to do nothing and wait. you firmly believe, look, there's going to be profit taken, this thing is going to fall back down below 87, do nothing. Your chances are 67% and your max profit per contract are 73. The second one was, do you know what? My mindset here is that these shares are going to stay above 87. Well, then just buy 100 shares, or buy the amount of stock you need to cover your position, turn it into a covered call. The third way is just managed by selling a put. And that's basically increasing your break even. So you can see your break even now is below 88.73, whereas above here when you were waiting, it was below 87.73. So you've given yourself $1 of breathing space here. But you've now added in a second probability. It has to stay above 83.27. So your mindset is the shares are going to be range bound. And that's why your probability has dropped, because now you've added in a second break-even point basically. But the good news is your max profit per contract has gone up by $100. The fourth way has got probably the highest probability of success. That's where you actually buy the stock and sell the $85 put. Again, your max profit has gone up by $100 per contract. And really all you want here is the shares to stay above 85. That's all you want. You want them to stay above 85. Once they do that, you're going to make money. So the answer is really how you manage these trades really depends on here, what your mindset is, what you think is going to happen. We will place one of these particular trades on Monday, depending. If the shares fall on Monday, we mightn't do anything. But if the shares, let's say, continue to rise or are above 87, we might place one of these particular trades. We'll post it as we're doing it, but we just wanted to give you the heads up as to how you would go about managing a position like this. This is Stephen from Share Navigator. Thank you. Bye for now.